Hey guys, it's Rudy coming at you from Palm Beach in Florida, live from Palm Beach in Florida. It is May the 7th. It is Wednesday, and obviously I've made a few videos over the past few days. They were mainly small caps or otherwise high dividend stocks like VAR Energy. Is it a dividend prize position or value trap? I appreciate all the comments on those ones. What I'm going to do today is actually focus on a couple of super majors, which ties in with some of the questions that were asked to me on the channel, right? So I've been talking a lot about small caps and even microcap stocks. And by the way, I have another meeting scheduled tomorrow with the CEO of Surge Energy. So I might make a follow-up video on that one as well, because it's an interesting one. If you've been following along, Surge Energy trades on the Toronto Stock Exchange, ticker symbol SGY. But maybe I'll do one of those. I'm not sure yet. I haven't decided yet, but that's not the discussion of this video today. I actually want to talk about the two U.S. energy supermajors. Let's get ready to rumble, right? Exxon versus Chevron. Now, there are a couple of people, including Ron, for instance, who asked me a question about which of the two do I prefer. Well, I talk a lot about Exxon, but I don't really talk much about Chevron. In fact, even if I make a video on super majors you could buy right now, typically I lean towards Exxon rather than Chevron. There are a couple of reasons why. I did mention to Ron when I was chatting with him on the comment section that I have a bit of bias because I've been and visited with Exxon before. I don't know anyone at Chevron, so that kind of plays into it as well. But why don't we objectively look at these two and sort of compare them? So over the past 1 year, in terms of where we are today, obviously, as I said, it's May the 7th, 2025. If we look back over the past year, Exxon is down almost 10% and Chevron is down around 16%. So both of these have basically underperformed. Exxon obviously doing a little bit better, has just underperformed the market slightly because obviously we saw a huge crash um, of the market, the stock market from Liberation Day, which is April the 2nd, when President Trump liberated us of all the cash in our portfolios. We've recovered a bit since then, so it looks a bit better now than what it did, for instance, at the beginning of April, so just a month ago. It hasn't rebounded completely yet, but some of the stocks have done quite well, including, for instance, today, Energy Transfer, after announcing earnings yesterday, was up around 7% the last time I looked. Anyway, you cannot really, if you're long in these positions, track them on a day-to-day basis. You need to look at it over a longer period of time. And the first thing you need to do is decide how much time you want to actually spend holding a position long. So this is over 1 year, but how about if we take a look over 5 years, right? Over 5 years, Exxon has been a phenomenally good performer. I have said this many times before, 15% compounded growth over 5 years doubles your position every 5 years. In this case, Exxon has not given us 100%, it's actually given us almost 150% over the past 5 years, whereas Chevron has actually been lagging. And over the past 5 years, it is only up 51.97%, which is not bad, but it's certainly obviously a significant difference, one being triple the other in terms of performance. The interesting thing is, if you look at the graph, you can see the trajectory of the graph. They kind of follow each other, going up and down. They pretty much do the same thing. Obviously, they're both victims of whatever the commodity price might be, but the performance of Exxon over the past 5 years has been absolutely great in terms of steady Eddie foundational stock you want to hold in your portfolio that also pays a nice dividend, which hopefully you can reinvest as well if you're able to do that. Now, let's take a look at some of the key points here. So the performance, both stocks are obviously down because of low oil prices. They cannot control the price of the commodity. So whatever the oil price is doing, it is impacting their stocks directly. And there's no way for them to really get away or out of that situation. You are subject to whatever the commodity price might be. And the commodity price for things like oil, West Texas Intermediate, Brent, etc., are set by the traders, not by the oil companies. So the standing joke is that the largest oil companies on the planet are companies like Goldman Sachs and Morgan Stanley, rather than companies like Exxon and Chevron. Right. So Exxon has outperformed Chevron, as I just showed you a minute ago. But here's the thing, right? So Chevron faces some issues with its joint venture. It's a 50% joint venture for Chevron in Kazakhstan. The company, the joint venture, is with Tengiz Chevron Oil, which abbreviated down here at the bottom of the screen. They made a name for it, which is Tengiz Chevroil, TCO. It's been delayed and it's over budget. This is not good, right? So, and in addition to that, Chevron is also in a legal dispute with Exxon. I'm going to talk more about that in just a minute, related to Hess's ownership in Guyana. This is a critical asset for Chevron's $53 billion acquisition of Hess. Chevron has also cut back on share buybacks due to the weaker oil prices we're experiencing right now. Exxon, on the other hand, has a much stronger balance sheet. Their debt to capital ratio this is for 2024, is only 7%. Their stake in the Guyana project is 45%. They're the major partner in that particular project. And they have a very robust buyback program of nearly $5 billion per quarter. The interesting thing, which I added down here at the bottom of the screen, is that in addition to Chevron, ExxonMobil also has a 25% stake in that joint venture in Kazakhstan, and so does Lukoil. Lukoil is one of my other stocks, which I no longer own because the government has put it into an escrow account because of the conflict between Russia and Ukraine and obviously the rest of the world. So I do own a couple of thousand shares of Lukoil, but on my portfolio it says it's worth zero because it's been placed in escrow until further notice. So for what it's worth, I've pretty much just written it off. At the current stock price of Lukoil, which is trading at about $70, you can do the math yourself. A couple of thousand shares at $70 is quite a chunk of cash, right? At least one Maserati. Anyway, it's gone. Key strengths, financial and strategic comparison. So stock performance, as I mentioned at the start, Chevron's down about 16% over 1 year, Exxon down 9.4. Exxon has outperformed Chevron, likely due to its stronger operational results and acquisitions like Pioneer Natural Resources. Ironically, these two acquisitions, Exxon's acquisition of Pioneer and Chevron's acquisition of Hess, are almost equal value, but the results have not been equal. And that's one of the reasons why Exxon has outperformed Chevron quite handsomely. The dividend yield, slightly in favor of Chevron. You could say arguably very much in favor of Chevron, because if you take the Exxon dividend, 4%, Chevron's more than 25% higher at 5%, so pretty good. Both of these are dividend aristocrats, with Exxon at 42 years of consecutive increases and Chevron at 37 years. You don't get much better than that in terms of dividends. I'm not saying you don't get higher dividends, you sure do, or you can, but in terms of being dividend aristocrats, you don't get a much better performance than these two super majors. Chevron's higher yield obviously offers better income potential if that is what you're looking for, which is the difference between stock appreciation and reinvesting or earning fixed income or dividends. Financial strength, Exxon has a stronger balance sheet. That's just a matter of fact. I'm going to show you that in just a second. I'll show you a snapshot of the financial fundamentals of the two companies, and you can compare. A superior net debt to capital ratio and significantly more cash on hand than Chevron. This provides greater financial flexibility for acquisitions, buybacks, and for weathering downturns, as we are currently experiencing in terms of the low oil price. So Exxon, for what it's worth, did a great acquisition with Pioneer. They're still doing buybacks at about $5 billion per quarter, and they are weathering the downturn much, much better than what Chevron is. And I'm going to share that with you in more detail in just a moment on this same page. But Exxon's lower leverage and larger cash reserves make it more resilient to oil price volatility. Earnings and cash flow, and here's a critical thing, right? You'll notice I planted some red flags as I go along, right? So this first red flag that I showed you is a joint venture in Kazakhstan, and now I've planted another red flag here for you just to pay attention to. So Exxon, this is for 2024, generated $36.2 billion in free cash flow, and its full year earnings were $33.4 billion. Chevron's annual cash flow comparatively, free cash flow was $10.7 billion. But here's the thing, right? In Q4 2024, so the last quarter previous to 2025, where we are now, Chevron adjusted earnings per share missed estimates with $4.4 billion in free cash flow for the quarter, which was lower than the $7.5 billion it returned to shareholders. You cannot have that type of a negative net on your balance sheet. This doesn't look too good. from an income statement and balance sheet point of view. So that's a bit of a red flag as well. They've addressed it though. Uh, and I'll talk more about that in just a second. But Exxon's higher free cash flow and consistent earnings beats highlight its operational efficiency and ability to fund dividends and do buybacks. Exxon paid $59.5 billion for Pioneer, which also boosted its Permian production by about 20%, and its 45% stake in Guyana's Stabroek block is a major growth driver. In fact, right now, Guyana is the little country which is located on the northern perimeter of South America, sort of in sandwiched between Brazil and Venezuela. It's the fastest growing economy in the world based on GDP. It's growing at about in the high 20s, 26, 27% growth, GDP growth per year. So Guyana is sort of Norway part two. Norway over the last 40, 50 years became one of the wealthiest countries on earth, and now Guyana is kind of following suit. And Exxon owns a 45% stake in that Guyana Stabroek block, which is a major growth driver. Now, conversely, so I said they're about similar in terms of the acquisition, right? So the $53 billion Hess acquisition, so Hess owns 30% of Guyana Stabroek block, right? So obviously, Exxon is a major partner there with 45, but Hess owns the other 30. And Chevron acquired Hess. But Exxon claim they have a right of first refusal or an option to first purchase the Hess ownership in the Stabroek block. And that is what is causing the hiccup for Chevron to actually conclude this acquisition. So this uncertainty with the $53 billion Hess acquisition is delayed by Exxon's arbitration of the Guyana assets. So the hearing is set for May 2025, but I think we're only going to get a conclusion to this towards the end of 2025. So who knows, right? I certainly don't know. If you're watching this and you know more than me, please share some information in the comments. But what I'm sharing with you is all I know. The Permian output for Chevron grew 14%, but the total production was flat for the company overall. Exxon's growth is more certain due to the completed acquisitions and the established Guyana operations, while Chevron's Hess deal introduces legal and timing risks. In addition to the timing, I mean, the legal expenses are high as well, because when lawyers are acting for or against multi-billion-dollar corporations, the legal fees themselves are quite incredible. From a Capex point of view, Exxon is planning 27 to 29% Capex 2025. In other words, they've basically maintained guidance. They're making aggressive investments in the Permian, Guyana, and in LNG. Chevron, on the other hand, is reducing its 2025 Capex by $2 billion and are now guiding to $14.5 to $15.5 billion for the year, 2025 fiscal year. And they are focused mainly on upstream and free cash flow generation over Permian expansion. Exxon's higher Capex signals growth-focused strategy versus Chevron, so a little red flag here again. Cuts. If you're cutting Capex, you are obviously also basically indicating to the market that you are more focused on financial discipline and shareholder returns, which is a good thing. But you have sort of two bookends here, right? The one company is aggressively spending Capex in terms of generating more revenue and driving aggressive investments, and the other one's cutting back. So they're not the same. From a valuation or PE ratio point of view, Chevron is trading at a slight premium, but it offers a better dividend yield. As I mentioned, it's 5% compared to 4%. And Chevron's higher yield might justify its premium for income investors, while Exxon's lower multiples will appeal more to value investors, right? So once again, they're not the same thing. We're not looking for the same result necessarily, depending on many, many different factors that I have no knowledge of, including your age, your investment hypothesis or thesis, your current earnings, your desire for fixed income or otherwise, or you're looking for stock appreciation, you're looking for dividend growth, whatever the case might be. I know none of these things, so all I can do is share information with you and hopefully guide you to make better decisions for yourself. The analyst outlook, so the smart people, not me. Exxon has an 11 to 22% upside. They rated a moderate buy. I got 11 buys and 5 holds currently. The analyst favor is cash flow and growth. Consensus target for Chevron is a 14 to 24% upside, so not dissimilar, but remember, Chevron's coming from a much lower base because they're down much more. Also a moderate buy, got 9 buys and 5 holds, about the same, right? Analysts see potential if the Hess deal closes, for sure. Both bullish outlooks, but the Chevron upside is tied to resolving that Guyana uncertainty. So another little red flag because there's an uncertainty, right? And as long as there's uncertainty, there's always a reflection of that uncertainty in the stock price, which is probably the primary reason why Chevron is underperforming Exxon. Risks and consideration, this applies to both of them. Oil price volatility, they can't do anything about that. They both face risk from low oil prices. Currently, WTI at around 57 per barrel, down from 77. That's a huge hit, right? So it's a hit right across the board. So gross income or sales revenue and free cash flow as a result, operating income, everything is affected by the cost of the commodity, which they cannot control. Exxon's cost cutting and vertical integration um, may better shield their profits. Exxon's Hess deal, so I've now talked about that quite a bit, but this is impacting Chevron's Guyana growth. The macro environment includes geopolitical tensions, for example, in the Middle East, and tariffs. Obviously, we've got this tariff war, as the media likes to call it, tariff war. It keeps popping up its head and keeps going on and on and on. And I'm not sure what the conclusion is going to be to that one either. But at the end of the day, what President Trump is trying to do is just create some kind of a level playing field and strive for fairness. Because if you're charging tariffs against me, then I'm also going to charge tariffs against you. So that's sort of the starting hypothesis. And you can argue about the way in which it's done and the manner in which it's communicated and all that kind of stuff. That's a separate issue. But at the end of the day, if you're looking for fairness, I think that's a decent ask and a fair request as well, right? So why should I pay 25% tariffs to you when you do not pay any tariffs to me? And there are many examples of that. I mean, you can go to almost any country in the world, and obviously I travel a little bit from time to time, and you can see that sort of at street level, right? You'll see, for instance, in certain countries, lots of European and Asian made cars, right? So Hyundai and Toyota and uh, Chinese cars like BYD for EVs and things like that. But you don't see any American cars. Why? Because they're subject to a tariff. And when you come to the United States, you can pretty much see everything except Chinese made vehicles, right? So there's not fairness in that situation. So tariffs is a complicated issue. And the communication and the style in which it's delivered is maybe questionable, but the concept of fairness is a reasonable ask, right? Sustainability trends, these guys, both of them are investing in a variety of different things. Exxon more so, probably just to appease the shareholders and to keep the green lobby at bay. So they make some investments in carbon capture, which is complete garbage. And of course, also lithium for electric vehicle batteries. Um, that's a red flag for me. Like this is not their core business, but they have to sort of do it. They're kind of obligated to do it just to you know, as I said, keep the green lobbyists and activists at bay. Chevron focuses more on traditional oil and gas, much better. That's what they should be doing. And with some AI data center ventures, which is okay. The red flag here is Exxon, not Chevron. Which one is better? For income-focused investors, Chevron is probably the better pick because of its higher dividend. And then the higher yield probably compensates for some of the near-term risk. For growth and stability, Exxon is probably preferable because of its stronger balance sheet. That's just a fact. It has higher free cash flows, completed its acquisitions, it's got lower leverage, so there are many, many things in favor of Exxon, whereas the only thing really right now in favor of Chevron is the slightly higher dividend. Exxon edges out slightly as the better investment for 2025 while Chevron remains compelling for income seekers. So if the critical thing for you or the main thing is the 5% dividend, Chevron is not a bad hold. But if I had to choose between the two, I would probably choose Exxon. Let's take a quick look at the fundamentals here. I'm not going to keep you long. I'm nearly done. The income statement, they look, sort of good as a general rule. But you can see the gross profit here. I mean, Exxon is significantly outperforming. And the only area where Chevron is actually outperforming Exxon, which is kind of slightly amusing or tongue in cheek, is on operating expenses, right? So even though they generate Look at the revenue generation, 339 billion compared to 193, but the operating expenses for Chevron, 38 compared to almost the same amount for Exxon, right? So Exxon with nearly double the revenue has almost the same operating expenses as Chevron. And that's one of the reasons why the balance sheet for Exxon is so strong. At the bottom here, you can see the difference as well, just in terms of the asset allocation, right? So look at the inventory for Exxon, almost 25 billion compared to just 9 for Chevron. Exxon's got it's got a great moat, and it's got uh, an ironclad balance sheet, right? It's pretty good. If we look at the cash flow, so here we're looking at the cash flow from operations, capital expenditures, and I talked obviously about Capex already, so I'm not going to go into any depth on that again, but look at the bottom line here, free cash flow, right? 15.04 billion compared to 28 billion. So Exxon's free cash flow almost double that of Chevron. The price ratios, we should always look at earnings per share, so EPS or PE ratio, price to earnings. And they're almost the same, so 15 and 14. Exxon price just slightly better than Chevron right now as a buy. And then at the bottom, you can also look at the enterprise value. But for most of what it's worth, as a general rule, Exxon is outperforming Chevron. How about this? Margins, right? So we have margins that are almost the same. The profit margin is almost the same. But remember, Exxon is generating this profit margin of significantly higher revenue, right? So it's very, very good. And even though the gross margin for Chevron is higher, their net profit margin is actually below that of Exxon. Equity return, favoring Exxon once again. Return on capital, favoring Exxon again. Institutional ownership is neither here nor there, 70%, 66, almost the same thing. The institutional owners are the usual culprits, right? So State Street, Vanguard, BlackRock, own pretty much the bulk of it. And remember, it's not those companies that own it directly, it's all the funds that they manage. So it's your money, my money, people in 401ks, IRA accounts, or whatever, a whole variety of different ETFs managed by these firms. That's where the money is. So I'm going to leave you with this one because I've referenced this quite a lot. And on the right-hand side here is my XLE. It's one of my favorites, right? I talk about XLE quite a lot. For the longest time, XLE, which is an ETF, an exchange traded fund, was sort of equally weighted, 2020. So the top 40% of their holdings, and by the way, their top 10 holdings is 74% of the total assets of the fund. But it used to be 20%, 20% for the longest time. And you can see the fund managers have moved and shifted this weighting very much in favor of Exxon and away from Chevron. The rest of them are pretty much the same as what they were before. Now, I've talked about XLE a lot, but I don't talk about IXC a lot. And some of our clients have this in their portfolio as well. It's almost the same thing, but you can see the weighting here has shifted as well, right? So it's Exxon almost 20% and Chevron now below 10%, more in line with the rest of the holdings. The difference between the two is that XLE is predominantly US, and I am very much long USA. So I'm long America, right? So that's one of the reasons why I hold XLE. IXC gives you a little bit of a different flavor. So if you don't want to buy a single stock like Exxon or Chevron for the single stock risk, you can buy these ETFs. And what you can do here is you can even diversify across these two ETFs if you'd like. IXC, their top 10 holdings represent 60% of the total fund of the exchange traded fund or ETF. The two top ones, again, are Exxon and Chevron. But you're getting a little bit of geographical diversification and currency diversification because they also hold Shell and Total Energies, Enbridge, which is one of my Canadian favorite stocks, BP, etc. So it's a little different. And right here at the bottom, Canadian Natural Resources, which I've covered a few times as well. So they look a little different from that point of view. But you could effectively, if you wanted to put money into XLE, it doesn't matter what the amount is, if it's $1,000 or $10,000 or whatever, you could say, instead of buying XLE, I'm going to buy 50-50. I'm going to buy half of, I put half of the money into XLE and the other half into IXC. And long term, if you hold it 3-5 years or whatever, you're going to be okay. So guys, that's a wrap on Exxon versus Chevron, the clash of the two super titans. And now I look forward to your comments, and you can tell me what you think. Is this a win or a lose or a draw? Which way are you leaning? Which one of the two is the better and for what reason? I hold Exxon long directly. In other words, I hold XOM directly in my portfolios. And in addition to that, I hold XLE, which is about 25% Exxon as well. So I have Chevron in my ETFs, but I don't hold Chevron directly. The only other super major, which is very similar to Exxon, uh, although it's mainly refining that I have in my portfolio as direct stock in the United States, is Phillips 66, which obviously took a huge hit after the April 2nd Liberation Day, but it's recovered a little bit since then, so it's looking a little bit better. Anyway, let me know what you think. And of these two, are you invested in either of them or even both of them, or do you hold the ETF? And let's see what you guys say in the comments in terms of which one of these is the better of the two. Take care. Thanks for watching. Bye-bye.